Hey guys, in today's episode, I'm going to show you how Uber and Lyft's IPOs are opening a brand new investment opportunity in the green rush.
And the big question is this. The green rush was a $10 billion industry last year. Experts say it's going to be worth over $20 billion by the end of next year. How do normal people like us, who didn't cheat by being born into the 1%, how do we use the money from our own pockets and participate in this massive wealth creation event while building financial freedom for ourselves and generational wealth for our families? That is the question. My name is Charles. Join me as we explore these answers.
Before we get started, I wanted just to kind of check in with you. I know this is not cannabis related, but it's been hitting the news, or I've been checking this out. We'll bring it back to cannabis for everyone who's tuning in. But wanted to get your thoughts. Have you looked at that Lyft IPO filing or all that?
I got a chance to kind of look at some overviews. I'm actually doing an IPO class in a couple of weeks for my audience. And Lyft, I thought it was really interesting. They are operating at almost $1 billion loss. I think they're like 990 million loss. And if their IPO does go all the way to market, they will probably have the biggest loss going to market ever. So I thought that was really interesting. And I'm really generally concerned about their model. Uber and Lyft, I think we get really excited about IPOs generally, and IPOs are initial public offerings. It's the first time that a Main Street investor can invest in a new company, or a relatively new company. And it's just, I'm looking at them and I think there's a lot of hype because of the excitement about new companies coming to market that are tech companies that were kind of become household names. But I think generally we have some really strong issues considering their profitability model and their model overall.
Yeah, no, definitely. Want to just kind of share my screen and show up. Lyft is obviously interesting, and Lyft and Uber represent a major evolution, I think, in our economies. But I think we'll also tie this back for people expecting cannabis stuff. I think it's useful and important to talk about Lyft, its IPO, and where Uber's going and where the economy is going, and look at also the fact that in California, there's been a big push for statewide cannabis deliveries. So I'm not sure if you've been looking at that. I thought this would be a fun thing to explore, new business models. Before we get into that, let's talk a little bit maybe about Lyft or Uber, or just kind of the general shift in trends, right? Where I guess it started with e-commerce. It started a little bit with Amazon. Now there's Prime. There's all these sorts of things. What do you see, or what do you think? Is this something that's is this a massive change in society? Is it just the same old stuff packaged differently? Is Lyft or even Uber an opportunity worth looking at?
I think disruption is, and I want to say Lyft and Uber, the kind of ride sharing model that they both represent, I think is really important for us to think about those companies as disruptors to what we call the regular rideshare taxi model. So I love disruptors. However, I think we have too much love for disruptors because at the end of the day, you may disrupt the industry, but you have to be profitable while doing it. And I think both companies are failing in that end. They're not showing the profitability that we really expect. So I think that's the problem that we have. So overall, do I love them as a idea? I do, but I think there's some real problems to deal with in terms of them being viable opportunities in the market, in terms of being in the public market.
Well, let's take a look at this. And you'd mentioned this $1 billion loss. I've got an article here. Lyft's 2018 net loss looms over its IPO filing. Let's see, by the numbers, Lyft lost $911 million. Wow, that's almost $1 billion. And it'll be a massive hurdle to jump, given that it would appear to be the largest ever net loss for a company entering the public markets for the first time. And as of now, there is no visible path to profitability. Wow.
And I think that's the bigger issue. It's like, okay, fine, you have a net operating loss, fine. But then here's the next thing is that when you go to market, when you're doing, and there was two options about the IPO filing that I thought were really interesting, is that you have the traditional IPO model where you engage underwriters and then you additionally offer more shares of the company. And then you have a direct model where you don't engage a underwriter or a third party, which would be, and let me clarify, an underwriter or a third party would be like a Merrill Lynch, a JP Morgan, something like that, or a company like that, I should clarify. So you're not going to engage on a direct filing or direct offering. You're not going to engage that type of company, and you're going to go directly to market basically with what you have. So you say you have 100 million shares, that's what you're going to offer to the public. But one of the things that kind of causes problems with the direct offering or direct filing is that you're not able to offer additional shares to the public if the public demand requires it, or I guess for lack of a better term, demands it. So I think that puts people at a loss when they're going directly. So on the other side, they're doing the more traditional IPO, more expensive IPO filing and adding additional shares. But again, when we look at the path to profitability, even if you add more shares, that does not, which means more opportunities to get into the company and infuse cash, are we just basically pouring our cash down a toilet?
And yeah, it's definitely a big concern, I guess. I'm reading this. It says, plus it's unclear that ride-hailing is actually a viable business. Uber once said its ride-hail efforts were profitable in large developed markets, but it hasn't reaffirmed that claim lately. And Lyft has never said that it makes any money. Maybe ride-hail should be a monopoly and doesn't work. Wow, that would be a very expensive lesson to look at this, because aren't they saying Lyft, or I'd heard somewhere, isn't Uber worth $100 billion or some astronomical number?
Yeah, their valuations are really out of this world.
Wow.
I mean, but again, I always tell people to look at the numbers, follow the numbers, look at what the company is doing with what they have, because again, they have a lot of private investors currently. They have accredited investors currently. And I think it's very important to look at that. And sometimes the IPO is just a way for those accredited investors and early investors to get out of a holding. So I'm not really sure, without really digging into their S1, which is their filing with the SEC, to really see what's going on with the company and where the management envisions they'll be going from here moving forward, once they do IPO. Like, where are we going? How are we attempting to get profitable? Even though, the critics are saying, oh, there's no measure of probability, there's no, clear path to get there. What's management saying is an option or a viable opportunity? And until I get into that S1, that initial filing with the SEC, I'm not really sure if I have an answer. I'm not moved by anything that I've been reading about them overall, but kind of the more general public commentary. I'm just really concerned.
No, I get it. So I guess the question, maybe let's take a step back from Lyft. Let's talk about this whole online delivery concept, right? Because if it was 20 years ago, we could have the same conversation when Amazon went public. And what's the difference between Amazon and pets.com? Amazon was famous for losing money, probably for the first 5 or 10 years of their existence. And what I'd like to step back and look at is, hey, is a service like Lyft or Uber, which is now doing Uber Eats, or Amazon, which has their Prime service, right? Is this at-home delivery something that is beneficial, right? Have our consumer behaviors changed where 10 or 20 years ago, we'd all go to the mall on weekends, right? We'd go to the Simon Mall property or the big mall. And, I think in Philadelphia, there's King of Prussia out there, right? Everyone would go to King of Prussia. The place would be jam-packed. And now today, I just want packages to show up at my house, or I want things delivered. I mean, what are your thoughts on that, Courtney? Is that a shift? Is it maybe just Lyft or Uber is a new thing? Is there a big trend that we should be looking at?
Well, I think we are members of the microwave culture. So I think, you know, instead of me going to drive to the mall to get something to wear, I pick what I want online and it comes to my door. I basically don't have to leave my house. And I think that's where we're moving to, if that makes sense, as a society, is that I want everything now. Even if I shop online, I want it now. So I think Amazon is really able to capitalize on that model. I think to kind of connect the dots with the cannabis economy, is that now we have this ability to kind of deliver weed to the house. So is that what this company may be going into? And I think it's really important. The riches are in the niches. And I think Amazon's niche isn't necessarily, like when Amazon first started, it was books. You know, that's what Amazon did, but they expanded and then they kind of drilled down to not necessarily being a book. They're not a book. You can get books there. You get books there all the time, but I think it's more about their niche is accessibility. That's really what they bring to the marketplace. And I think my question about Uber and Lyft in terms about what they bring to the marketplace in terms of this long-term profitability is that what kind of micro niche do you have in your current model that would make you profitable and more than what you are right now? And I also know where they're losing their money. I think those things are important too.
You know, that's actually a really interesting point you make, right? Because if we look at Amazon today, we look at Amazon as a platform. And since we're speaking of niches and riches, I'm going to find another niche provider, right? But if we look at Amazon today, we look at Amazon as a platform. But if we looked at it 20 years ago between Amazon versus pets.com, Amazon was selling books, pets.com was selling pet materials, right? Same old thing, right? You know, what's the difference? Yet Amazon became a platform. Now, maybe let's dive into a different niche, which is similar, I think, to Uber and Lyft. In fact, Uber's gotten into this space, the home delivery, food delivery. And let's look at a company called GrubHub, because when you said niche, that made me think of GrubHub. I actually pulled them up. Have you ever used GrubHub before? Have you used a meal delivery type service?
I have, but I want to say I've only done Uber Eats because I'm not like a huge meal delivery person. But
okay.
But I think one of the things that I loved about Uber Eats is that places that didn't normally deliver kind of their own kind of, I guess, supply chain or whatever service model, I should say service model, that's more appropriate, like of their own service model, they didn't do their own delivery. So I had to get in my car and go and pick up my food.
Yeah.
So now, you know, now that I have this opportunity with Uber Eats, that's kind of what made them even like me put them on my radar, is that you're not just delivering pizza, you're delivering Indian food, you're delivering all the things that I normally would leave my house for. So again, it's kind of like that same idea of like the Amazon model, but I've never used GrubHub before. So I would take a look at them.
Yeah, I'll tell you a little bit about this. So GrubHub is it's an app. In many ways, it's kind of like Uber or Lyft, except that GrubHub does meal delivery. So they don't own any restaurants, they don't own any food. They have an online website and an app, and they basically have synced up with all these restaurants, similar to how Uber or Lyft would sync up with all these taxi drivers. And you just order food from your restaurants. And instead of having to call each restaurant directly, I can go to GrubHub, I can look at 30 or 40 of these different restaurants and go from there. Now, what's interesting, and the reason why I brought that up, was when I was looking at Uber, a lot of people are saying, well, maybe Uber or Lyft, like they're trying to compare Uber or Lyft against a company like GrubHub. And GrubHub is a public company, so you can look at these numbers. And what's interesting, I mean, the thing is they've actually proven a business model for some type of online delivery service, happens to be food for all intents and purposes, right? And if you look at their revenues, they had about $1 billion in revenues last year. So, and they were profitable. They brought in about 78 million. It looks like they've been pushing growth. While the previous year they brought in close to 100 million in revenue off of $700 billion. And they are currently trading at, if we look at GrubHub as a company, right? So $1 billion, you're looking at 80 million in net income. And if I go back to their summary page, they're sitting at a market cap of around 7.2 billion. So PE is a little high because it still is a bit of an app, technology company at 94. But when you look at market cap, price to revenue, you're trading at 7 times annual revenue. And again, I'm not saying, GrubHub's, I'm not saying, hey, let's go buy GrubHub or anything like that. But I think it's good when we look at companies like Lyft, or when we get into this cannabis industry in terms of these sorts of applications, would it be very, do you think you could value Lyft at 7 times annual? Could Lyft become GrubHub, or could Lyft, I don't know, become, or is Amazon, like, I feel there's something in this industry, because a company like Lyft, or a company like Uber, or even GrubHub or Amazon Prime, that's definitely changed how consumer behavior is. And life is better post GrubHub, post Lyft, post Uber than pre. Now, yeah, you ultimately have to make money on that side. And there's lots of companies that have traditionally not done very well in the beginning, right? Look at Snapchat, look at Facebook. I mean, they were not going, they weren't bringing money in when Facebook IPO'd. It wasn't doing very well either on that front.
Right. No, I agree. But Facebook actually was profitable when they IPO'd. And I think that
were they? I recall, and again, I don't remember exactly, but I remember Facebook did not make money for quite some time.
They did, but if you look at their S1, you can see that 2000, and I think they IPO'd in 12. If you look at their docs actually show that they were profitable. I mean, they weren't killing the game, but they were profitable. That I can recall, because I remember looking at their S1 going, okay. And that's why I even looked at Facebook to invest in. But one of the funny things about Facebook is I actually jumped out when they had that dip, and I never got back in, and I'm still kicking myself.
Oh, are you saying the Cambridge Analytica dip, or?
No. It was a dip early on. It was a dip like maybe like late 12, early 13, somewhere in their history, they did like a dip. And I was like, oh my gosh. And I don't even know why I did that, because that's not typically how I am as an investor. And I'm still like, oh my gosh, how did I do that? I'm still kicking myself. Like that's biggest investment disaster to date.
Well, it's life, right? You don't win them all.
Right.
But let's segue into this online delivery side and this business of cannabis delivery, and whether or not that's a big thing and whether or not it makes sense. So on the one hand, we have GrubHub, and then on the other hand, and this is a recent development, this was USA Today. They published it in January, but actually the law got passed in December that allowed for statewide deliveries of cannabis. Now, are you familiar with this regulation, or do you want me to dive into it a little more, Courtney? And give you
I think probably diving into it a little bit more would be great, because I read this article, but it wasn't really clear, because it seemed like a lot. What my concern was is that there were some counties, or at least municipalities, that were not allowing it, and the state law was basically trumping it. And I was like, okay, that's going to be a lawsuit.
No, I get it. So yeah, let me give you kind of a quick update, and we'll dive into this. And I suspect we'll be chatting more about this, because I think it's an angle to explore, right? Because you're all about the regulatory stuff, you're all about these changes, and it's all about the opportunities. So if you step back and look at how California was originally set up, you have licensed dispensaries, and you get a license for your dispensary in a particular region. And a lot of the licenses are, there is a regional flair to them, because if you go back in time for how the rules were, even though there were California legalized statewide medically, counties didn't follow suit. So there are actually instances. I have an acquaintance I know, or a friend, who she was a card-carrying medical patient back 10 years ago. And she was driving, and she picked up her medical marijuana in one county, and she was driving, and I think she went from Northern California to Southern California, and during that drive she got pulled over for speeding, and she got pulled over in a county where the county didn't recognize statewide legalization. And then when the officer pulled her over, smelled obviously the smell of marijuana, she got thrown in jail and had to deal with that whole thing, because even though it was legal in her county to have medical marijuana, and again, keep in mind, this is 10 years ago, this is, things have become more progressive. Even though it was legal 10 years ago in that county, the other counties still didn't recognize it, and there was a marijuana possession. Like it was just a big mess, and she had to go clean it up, and had to go to the judge. Actually, had to serve probation. I mean, like there was all sorts of nonsense that went with it. And you fast forward 5 or 10 years, there still are challenges, but essentially, to put it on a high level, you get a dispensary license, and the dispensary license effectively gives you some sort of jurisdiction, whether it's a city, whether it's a county, whether it's some sort of a regional area. And the reason why they've done it that way is because different counties have different regulations, they have different taxes, they have, in some cases, even different products that are allowable or not allowed, just because some counties are more conservative, or, you know, it's kind of that not in my backyard feel, right? People say, okay, we want marijuana legalized for the tax revenue, but I don't want that dispensary sitting near me, so we're not going to have it in this area. So with all those, it was basically a big patchwork of laws, and it was just a big mess. So what's happened now is, as of the end of the year, California it started with first legalization. So what had been going on was there was a huge underground market. And I'm bringing up this company because this is an interesting company to look at. It's called ease.com. And they are essentially the Uber of cannabis, where, again, Ease is an app similar to Lyft or similar to Uber or potentially like GrubHub. And you download the app. And basically on that app, you kind of say where you are, what you want. You know, you put in your address. So I don't know, I might put in an address of, 555 Palm Street. Let me see if I can find a California. Is there something in Oakland maybe? Okay, 555 Palm Street in Oak Hills. Oh, not in the service area. Exactly, right? So literally California is sliced in ways where you had service areas based on dispensaries. What happened was, before that was, at the beginning of 2018, there was this still underground market. And what happened is, when legalization rolled through, they allowed for some amnesty, where it was like, okay, we know you're licensed, you are licensed, but you're kind of running under the radar. We will let you come up and be legitimate for a period of time, and in hopes that you get your regulatory stuff doing, you fill out all your paperwork, you dot your T's, you cross your I's, and then you won't be persecuted by the criminal justice system. And then after that happened, they aimed for saying, okay, now everyone's licensed, and let's actually, let's have some order to this patchwork mess of laws that don't make any sense by county or by jurisdiction and everything on that side. Okay, so that's kind of the high level. And then the next step was delivery became an issue, because what might happen is somebody in one city will say, hey, I don't want this type of cannabis in my area, or the dispensary might say, hey, this is my spot, and someone else wants to order another spot. But from the consumer perspective, maybe I like one type of a product and I want to get that product in my spot. So basically what's gone on is, as of the end of last year, and they're still working out the details this year, they've actually okayed statewide deliveries. So if you are if you have a license or whatnot, you can actually go and deliver wherever. So if I'm a dispensary in the Bay Area, I could feasibly just have someone, have my product delivered to LA or to Sacramento or some other place. Does that kind of give you an understanding of how that comes together?
Yeah, I'm always talking about regulatory things because this is very regulatory intensive, and I'm chuckling. And the reason why I'm chuckling is that there was I believe there was a Supreme Court case years ago about, I want to say it was like maybe the 1920s, 1930s, about how municipalities are not independent of the state. So basically the municipality has no standing to kind of buck a state regulation. So basically that's what they're doing here. But because marijuana is not legal on the federal level, so I think it creates a very sticky, for lack of a better term, situation here as it stands currently. So it seems like California as a state, the ability to kind of impose its regulatory scheme and its law is going to be hampered by the federal law of marijuana still being illegal. Is that so? It seems just like a huge mess, and I don't think we're going to get any resolution. Maybe through the California Supreme Court, maybe, but I'm not sure. So I think this is just going to be a continued mess going forward. And I think it's going to hurt the profitability of these companies that have already kind of complained that their profitability is hampered by regulations and not more or less regulations, but more so taxes vis-a-vis regulation.
Yeah, I don't know if you can see the map I have in terms of their delivery zones. Mm-hmm. Traditionally, it's a patchwork framework. Hold on, we'll just let this load for California. You've got these patches of where it has been allowed and where it hasn't been allowed, and places where it can be delivered and not, just because of the whole regulatory side. Now, what's interesting here, and this is where the opportunity, so now obviously there's ease out there, but the question is, will ease be the one that dominates, or is the licensure going in a different direction? And the reason why I bring this up is California, like, cannabis is different than just food, right? Or cannabis is different than taxis. Though you could make an argument that it's not. Well, but like cannabis has some very, specifically the medical side and even the recreational side, has some very specific licensure requirements because of the whole federal side and everything, because they're saying, hey, there's legal cannabis, but you can still get picked up for drug trafficking if you're moving around illegal cannabis. So many of the questions, and I'll just kind of leave this in your thoughts, Courtney, just kind of chew on it and talk about it. We can come back maybe next week to dive in deeper. Many of the questions around this has been, can a company like Ease actually survive, or will it be a dispensary? Because you can't just, like, as California works right now, Ease currently with the new rules can only connect a user to a dispensary that has someone who's licensed for delivery. So you can't just, like, it's not like an Uber driver at this point, from my understanding, where, hey, I can just go to the Uber app, sign up, and all of a sudden I'll start getting, it's like the gig economy where I'll start getting jobs for delivery. I actually have to go through someone who's licensed, because you need to be actually licensed for marijuana delivery, which is somewhat tied into your dispensary license on that front too. Do you see what I mean? So this goes into that whole, in some states, you've heard the term vertical integration versus horizontal integration, and all those sorts of things to work out. There's companies like Ease, and now I'll pull up another guy. This is, let's see, it's called Cali Chill. So this is the Uber versus Lyft debate. Mm-hmm. This is the equivalent on the cannabis side, right? Uber versus Lyft, or Ease versus Chill. Now in Chill's case, Chill is actually they are more vertically integrated. So unlike Ease, who's just an app, Chill actually has the trucks, they have the people, they even have the products. They're an actual distributor. It's like they're a dispensary, not just an app that connects consumers to dispensaries.
Okay.
You see what I mean?
That makes a huge difference.
It does. And what's actually fascinating, and this is where it becomes interesting, right? So Ease has actually gotten a lot of PR. I mean, they've raised, I think, I can just look it up really quick. Ease fundraise. I guess I can always look at TechCrunch, right? Ease has raised a lot of money. So if you look at it back in September 2017, they raised $27 million. One of the investors behind Ease is Casa Verde Ventures, which the notable name behind Casa Verde, I believe, or I think it's Casa Verde, is Snoop Dogg. So when you have someone like Snoop Dogg that's invested in your company, I mean, of cannabis, so it looks like they've raised $51 million. They've raised $51 million on that side, right? So in many cases, they are like a Lyft or they're like an Uber, but a smaller version of them. focused on that niche. Lots to think about, right?
Yeah, yeah. So I think that's going to be the model going forward. I think the question about the model of, are you just kind of like a Uber kind of transporting between, or are you more like a pizza delivery guy? And or gal for that matter. So what is your model? So are you adding this delivery service to your current existing model, or are you relying on being the intermediary between the other dispensaries that are set up currently? And I think each one has probably its benefits and drawbacks. I'm just not really sure which one is the better model for where it stands right now. And I think maybe time may tell which one's the better model.
Yeah, I mean, I think it's more the conversation, right? Uber Eats versus Jimmy John's or Domino's, right? Jimmy John's is vertically integrated, and you hear their ads, and Jimmy John's is right there, or Domino's. I don't know if they still deliver. I haven't ordered Domino's in ages, but it's vertical integration versus Uber Eats or Amazon Eats or GrubHub or whatnot, and to see where all that comes together and whether that is something. I guess it boils down on the cannabis side to, I think it really boils down to value add brand and or commoditization, right? Mm-hmm. So if I look at a taxi is just a vehicle to get me from point A to point B, right? All I care, it's transportation. Yeah, I'd like a nicer car, but generally speaking, if the car is relatively clean, it gets me there on time, and I arrive on time, like the experience of riding in the car, I don't really value that much, right? Mm-hmm. Versus if I look at a restaurant, it's more than just delivery, it's the quality of the food, because there are some restaurants where we'll go and, we all have that one restaurant, right? We'll go wait in line for 30 minutes just to get that seat, and then another hour to deal with awful service because the food's just so darn good. Right? So it'll be interesting to see on the cannabis side, is there a cannabis extract or a plant or a type of flower that's so darn good that I'm willing to go to it, some niche craft product? Or is it just something where, hey, as long as it comes to my door, it comes to my door and it's all the same? Yeah, and I don't have that answer.
There's a little bit of a conversation. I think you brought it up earlier about kind of anything that was done below the radar, like pre-2018, that was produced or harvested pre-2018. Companies or dispensaries or whoever had until July of 18 to get rid of it. And there was one particular cookie where they couldn't keep it on the shelves in California because everybody loved it so much, but it was significantly higher than what California allowed. So I think...
Oh, in terms of THC levels or something.
Correct. So I think it's really interesting that you kind of bring that idea up. So I think, honestly, where you're going to hit that kind of sticky spot, I love using sticky in this context, you're going to hit that sticky spot because people are going to be searching for the highest allowable THC. That's kind of see where everybody seems to want to go. And I don't really see that function or that push in alcohol so much. I think that's really interesting. When sometimes people just have like their drink and they're like, this is my drink, this is my alcohol, this is what I like. And it doesn't matter, and I should say it doesn't matter, but it's not as big a deal, the alcohol content. Like when we look at 151, you're like, oh, I'm getting 151. But not many people are like, 151 is my drink. That's not how people really function. But
it might not be a content, but it could be brand or it could be a flavor profile, because some people are like, hey, my craft beer, I need that craft beer. And I don't touch anything else. I don't care if it's something else has 3% versus 2%. It's the craft and yeah, you know what I mean?
And there is, and I think we have the other side, the flavor profiles. I think there's a lot going on that I don't know how the general market is going to respond. I can only kind of take little antidotes from like little things that I'm reading here, little things that I'm reading there in terms of looking at like, hey, we love this thing. And one of the biggest things that's being touted about it is the THC content, as opposed to something else where I have noticed that some really are looking more at a flavor profile. So it just really depends. I don't know. It's so interesting because we have so many different unknowns about how the market is going to react to this.
No, definitely. So before we wrap up, wanted to just jump back. I know last week we talked about CannTrust, and I've been doing some more digging on CannTrust. And actually, I'll be guilty. I looked at what you said, I dug in a little deeper, and I pulled the trigger.
Did you?
So I got some, obviously not at the pricing you got it. I think I paid about $9 a share. So, you know, you got what you said you got in at like $7 or?
Yeah, I have to actually look at the accounts where I got in at. But yeah, because Hexo I got in at one place, and I thought I wasn't really paying attention. But I was like, oh, I think I got in around 7. It wasn't as high as 8, I don't think. But I'm actually looking right now. But you know, I'm excited that so what really won you over? I'm just curious.
Well, what got me going, and I want to talk about, and I actually have a question for you, because I didn't put in a full position. I just kind of threw in a little bit of stuff, just because I don't know. I think what really happened was I had FOMO. I mean, I'll be perfectly honest. But what I did was I started looking at some comps. I dug further into CannTrust, and if you recall, you know, we were digging into it, and you know, they're actually a legitimate company in Canada. You compare them, you know, I looked at it, they have about 20% market share in the medicinal side. They're head-to-head against Canopy Growth. They're head-to-head against Afria and some of these other people. And I said, okay, well, I found this company called Green Thumb Industries. I don't know, are you familiar with Green Thumb at all?
I am. Have we talked about Green Thumb before?
I don't know. I mean, we've talked about so many marijuana companies, but I was looking at them versus Green Thumb. And I looked at them and said, hey, these are two companies that are pretty darn comparable. I'm not saying they're exact, but you know, Green Thumb, they're bigger than CannTrust. They did about $18 million. They're OTC, and outside of operating and stuff like that, like their balance sheet looked a little better than some of the other ones, right? So this is, let's say, like a smaller provider, right? And if you look at it, you know, CannTrust is slightly profitable. Green Thumb is losing a little bit of money, but isn't awful. And I looked at the comparable valuations. So Green Thumb has a $2.6 billion market cap. Mm-hmm. And obviously Green Thumb has about a call it 60% greater revenue value multiple. And this is at 960, and now the chart thing is different, and I can't find it on Yahoo Finance, so I'd have to pull out different software. But CannTrust at $9 was trading at like a $900 million market cap. And the price to revenue ratio of CannTrust versus Green Thumb was significantly cheaper. Or not significantly cheaper, but like there was a variance, right? So if I were to look at Green Thumb, if we go back, right, it was 17 million, or let's say 18 million for the quarter. So 18 times 4, that gives me a $72 million run rate company. Divide that by 25 billion, so 2.5 billion divided by 7.2. That's a 33, call it, you know, price to revenue ratio. Mm-hmm. So, you know, that's pretty high. It's better, it's high, but it's like better. And if I look at for CannTrust at 900 divided by, say, 50, excuse me, that came out to 18. So basically, if you look at relative valuations, CannTrust was 50% of what Green Thumb was. Mm-hmm. And I liked Green Thumb better than, say, Kronos or Canopy, because I view Green Thumb as like another kind of under the radar type of you know, cannabis provider. Mm-hmm. So CannTrust was running at about 50%, and then Green Thumb is a U.S. company, so they're not going to blow up. They wouldn't have blown up last quarter, and I then factored in, okay, there is some sort of a bet that you know, with how Canada legalization and rec came about, because as I looked into it, it was like CanTrust was a player as much as Cannabis Growth was, or Afria. They're probably likely to sell out 100% of their capacity just because Canada was blowing up on that front. So then I looked at that and said, okay, let's say they do and they double their revenues like how we said. If we did that, instead of doing 12 million, if they double their revenues, that's 25, 100 million, 900 divided by 100, that came about a 9 times price to revenue ratio. Do you see what I mean?
Yeah.
And at a 9 times price to revenue ratio, plus the fact that they're profitable, which for me, you know, I mean, you talked about Lyft and everything. I'm actually all about cash flow. I like to see companies that are profitable. Now, I understand if they're investing in things, and I do also understand the land grab. That gave me enough of, and I'm usually not a grower investor because I think most of these grower valuations are completely out of whack. But that gave me enough to at least kind of dip my toe in the water, and I took what I call a half position. So when I do these speculative ones, I have half positions and full positions, and sometimes I do double up. But because I'd taken some profits, I'd mentioned, I think to you, on Chiron and Elixinol, I had some powder in the keg, and I put a little bit into CanTrust just to see how that goes. Now, the question I have, though, and I don't know if this has affected this, now this is where it becomes interesting. Immediately after I think I put money, or 4 days later, it looks like they just filed another authorization to raise another $700 million, or 700 Canadian, so $500 million to really fund that war chest. Did you see this?
Yeah, I did. It kind of popped in my, I try to keep my Google alerts current with what I'm interested in, because like this industry moves the speed of light, and it's just impossible to keep everything up on your radar. So I love Google alerts just to kind of keep me in the know. And I saw it pop through, and I was like, okay, I have to read this. And then I just didn't get a chance to yet. But I was just like, okay, you got authorization. Well, let's see where my question is, when additional money gets added, it's always, where is it going? Where are you putting this? Where do you feel like you need additional money? And is the additional money going to yield a significant ROI, a return on investment? Like, are we going to put in 500 million and we're expecting, or are we expecting to get $1 billion back? Or like, what are we expecting? Like, what do we look for? And sometimes you're not going to see that over like a year. You may see it in 5 years, but it has to kind of conceptually have a bigger place that I'm just going to dump this money into the company with no sense of a real return, because I think that's where we start to get into trouble.
No, I agree. So I don't have an answer. I mean, this filing basically doesn't say what they're going to do or what's going on. If you look at the news, all that's happened is they've said that they are looking to raise more money, you know, to the tune of $500 million over the next, it looks like, 25 months, either through debt securities, war. I mean, it's a very open-ended statement at this point.
Right. So
they're saying, hey, we're going to raise another $500 million US or 700 million Canadian because we want to go take on the world on that. I mean, that's essentially what they're saying. Now, what's interesting, I guess, and this is right, you know, I wish I'd gotten in early, right? Because in December it was $4.50, and now it's up to $9. So it's doubled in the span of 2 months. The question is, and this is what I kind of, maybe I'll leave with you, we'll talk about it, then we'll kind of wrap up, is CanTrust now on the cusp of becoming another Canopy Growth, or becoming another Tilray, or becoming another Kronos? Because that's the big thing, right? When Canopy got that $100 million, multi-billion-dollar investment through Constellation Brands, all of a sudden it was like, boom, they blew up. And right, if I go back to it, they're trading at a crazy multiple on earnings. So is there a reasonable upside to think that maybe CanTrust could approach a Canopy Growth valuation level, right? Because if we go back to that.
Well, I always think that Canopy Growth has that first mover advantage baked into their their numbers. I don't know if we could ever get there, but I do think, to your point, can we be more in the space of a Kronos, a Tilray, somewhere in there? And I think so. That's the only reason why I would even get into them, if that makes sense. Like, do I see them with the potential of being a bigger player, or let me clarify, a major player in this space by being on the radar of a company that has, I don't want to say unlimited resources, but significantly more resources. So that's what I'm looking for. So we have Constellation Brands and Canopy Group, and then we have Altria Group and Kronos. So it's kind of like, okay, is this company in line for the next big player or next US big player to jump in and kind of pour into them some money? So I don't know. So that's what I'm really excited for, and that's what I'm looking at in the next 18 months with CannTrust.
Yeah, no, and definitely, this is not a 30-day window. I mean, I'm not looking to day trade this at all, right? But I'm looking at this, and I guess the next big thing will be, CannTrust should be due to report earnings pretty soon, I would imagine, right? Yeah. So that will be the big thing, right? Because if I look and compare side by side, right, Canopy growth, let's go back to quarterly numbers, was 23 million in September 2018, and at the end of the year, they jumped from 23 million to 83 million. And then CannTrust is sitting at about 60% of what Canopy growth was, and they were at 12.5 million. So if they jump to, they should jump in the same way, because they're both in Canada. Recreational legalization occurred and everyone sold out because of the supply shortage. They should follow that curve. And if they do, if we look at what Canopy was trading against the 2018 multiple, that's basically, what is it? Let me just do the math again. This was 23. So let's say it's $100 million $100 million revenue run rate. Then we're looking at, what do we have? 116 billion divided by 100. That's 160 price to revenue ratio, which is insane, right? Right. Versus that's where they're 160, while CannTrust right now at 50 is at, let's see, 900 divided by 50. CannTrust is running at 18. So the question is, I agree it's not going to get to 160, but could it in 6 months maybe level out at 30 times, 20 times? Do you see, like could it get a little more? And if it does get to that little more, I would be really happy.
Yeah. And I think that's the biggest thing, is that, do these companies move in a way that we would be happy with the result? And I think everybody, and I think I was just at a conference this week and I'm speaking, and I was telling people, I mean, you're not going to get rich off of one stock. And I think that's the biggest thing when we talk about diversification and have these kind of diversification conversations. It's not just going to be one. It's about making smart plays across the board. And not every smart play may not work out, because we're working with the market. And even there's a lot of companies that I think are undervalued in the marketplace, but they're just not moving in a way that they probably should, given their numbers. So it's the kind of, at the end of the day, the way you, I don't want to say save your portfolio, but you really protect your portfolio.
Yeah, well, that's everyone always asks, right? What stock should I get, Courtney? What's the magic one? And the honest truth is, if I had that crystal ball, I would put everything on one stock. I wouldn't even bother with diversification or asset allocation, right? If we had that, but we just don't. So with that, I think that's a good way to end today's episode. So everyone, thanks again for tuning in. Until next week, Courtney and I will be back on Tuesday afternoon, and we will see you guys soon. Talk to you later. Bye-bye.